Greetings to all our IMAPS clients and investors. Let me walk you through the changes made during the first week of July. The first semester of 2025 has been a period full of tectonic changes driven by pivotal fluctuations on almost all fronts. When we think about it, degrees of change are mostly determined by two factors, direction and magnitude. While direction was never a surprise considering the many promises of the Trump campaign, magnitude was the factor that ignited market uncertainty. The current perception is that we are past peak uncertainty regarding tariffs, the US fiscal budget, NATO relationships, immigration, and escalation of the Israel-Iran conflict. However, that does not mean that we are completely out of the woods yet. The next few months will likely continue to see additional air pockets which need to be navigated to get to the end of the year. Both the soft and hard data continue to show a deceleration in economic activity highlighted by a softer labor market as well as declining real estate and oil markets, all while we continue to wait for the inflationary impact of tariffs on the economy. It is important to be aware of the clouds on the horizon, but let us not forget our main investment thesis, which is based on the idea that the US economy remains robust as consumers continue to spend within the context of a healthy financial environment. The geopolitical landscape has experienced a meaningful tectonic shift. The US decision to strike Iran, effectively ending Iranians' race towards attaining nuclear weapons, is not only an incredible victory, but has also revealed that the axis of evil was much weaker than anticipated. Preoccupied with its own conflict with Ukraine, Russia was unable to provide military support to its so-called ally, while economically troubled China limited its intervention to publicly condemning the attacks on Iran. The US drivers to consider for the back half of the year are, on the fiscal side, the Big Beautiful Bill, which is expected to pass the Senate without substantial changes, while the final figures of the SALT cap and Medicaid cuts remain on a work in progress. The controversial section 899 will likely be removed from the bill. On trade, the last mile of tariff negotiations with major trading partners will likely cause market volatility over the next quarter, although the levels of tariffs is expected to converge with values that counterparties are going to be able to live with. The key expected tailwind will be the Fed's decision to cut interest rates. At this point, the market is already discounting a cut in September, as well as at least one more cut before the end of the year. While, according to our proprietary recessionary indicator, recession probabilities over the next 6 months keep lingering above 40%, the resilience and financial health of the US consumer will most likely allow the economy to either delay or successfully emerge from a possible recessionary environment. The fixed income portion of the portfolios continue to maintain a 5 to 6 year duration range, in line with its benchmark. It is in the middle portion of the yield curve where we can benefit from Fed cuts, while remaining sheltered from curve steepening as a result of the deterioration in the US fiscal deficit. Cash was deployed to increase the allocation to high-grade corporate bonds and employ a credit hedging strategy, with an emphasis on credit quality and diversification as a tool to keep volatility low. To maximize income generation, the allocation to high yield has been increased to neutral, favoring the higher quality component of the high yield space to keep credit risk exposure limited. The goal of the strategy is to have a persistent income generation provided by coupon payments as a source of returns to support the portfolio, within the context of sideways movements by the US equity market, which could see limited upside potential. According to most Wall Street analysts, the US equity market is already hovering at or a few percentage points away from 2025 targets, from which the expectation for the second half of the year is flat or slightly up equity market. Cash was reinvested into equities with a focus into sectors such as information technology, financials, utilities, consumer staples, and communications. The allocation to large cap was increased while reducing small and mid-cap managers to increase portfolio resilience. Allocations were concentrated into quality names to capitalize on securities well-positioned to perform well during the rest of the year. We have kept constant the allocation to alternatives where gold and commodities greatly contributed to portfolio performance. Finally, the allocation to emerging markets equities was increased from underweight to slightly below neutral. We expect that the resolution of the tariff war, together with net positive flows outside of the US, will provide support to this asset class. Furthermore, we have introduced a new manager with a quantitative multi-factor approach whose performance has outperformed passive investing over the last 5 years period. We hope you are well, and always please reach out to your financial advisor or investment professional with any questions you may have. Thank you.